Hello, this is Leo from Maverick Investor. Back again on the currency mortgage series. This is part 2. You should by now have watched and listened to part 1, which is the introduction. And as we said in the introduction, there are 3 different types of currency mortgage that you can choose. And what I'm going to do is to run the next 3 little videos. Each one will concentrate on one of those. And we're going to start off today with the simplest one, which is the single currency mortgage. Now, the single currency mortgage is exactly as it sounds. You are going to take your assets, which are based in your country, in my case in the UK, and you're going to use them as security to get a mortgage in a different currency than the one you've got at the moment in your home currency. Now, the example we're going to use is the Japanese yen, because that remains the lowest interest rate around the world at the moment amongst all the major currencies. And here's the advantage. Here's the big advantage. The interest rate that you're going to be paying in Japanese yen is going to be about 1.9%. Now, compare that to whatever it is you're paying right now and just see what kind of an advantage that is. That's the big advantage. Now, as usual with these things, there are risks as well. Now, what's the risk, do you reckon, with a single currency mortgage? Okay, it's very straightforward. The risk is currency exchange rate movements. The currency exchange rate can move quite drastically on a minute-by-minute basis, and if it moves against you, then you're going to end up paying more each month in mortgage payments than you originally budgeted. Now, let's just run an example. It's the 16th of December today, 2007. I've just checked online, and the exchange rate between the Japanese yen and the pound is 229. So you can get 229 Japanese yen for every pound sterling. Now, if I have £1 million yen to pay every month in my yen mortgage, today it's going to cost me £4,367. £4,367. If the yen changes by next month from 229 to 235, then guess what? I've only got £4,255 to pay. That's over £100 less that I've got to pay the next month, which is brilliant. However, here's the kicker. What happens if it goes the other way? What happens if it changes from 229 today to 215? Well, that means that next month I'm going to have to pay £4,651, which is nearly £300 more than I paid this month. So that's your risk. There are ways around it. We'll be exploring those at another time. But the benefits are huge. And let me just underlie that benefit for you a little bit further. In the UK, at 5.5% mortgage rate right now, if you're paying $4,500 a month, then your mortgage is going to be roughly £980,000, or your collected mortgage value is going to be about £982,000. Just to translate that, if you're paying the same amount of money, so I'd say £4,500, which is the average of the 3 figures that we've been talking about, so just in round figures, if you're paying £4,500 in sterling for a sterling mortgage, your total mortgage outstanding will be $982,000. If you were paying that same amount of money into a Japanese yen mortgage, then that mortgage would be around £2.85 million. So we're approaching 3 times the total outstanding debt that you could have for the same amount of money going out. I'll come back to you next time with the next method of doing currency mortgages, but this was single currency mortgages, and we'll see you later. If you need any more information, by the way, go on to the Maverick Investor website, maverickinvestor.com/MCM. We'll see you there. Bye-bye.